This is James Altucher at TheStreet.com TV here with Mad Money TV show host Jim Cramer.
James, I want to switch the tables for a second on you. I have been piggybacking, and that's really the word that is correct. I don't think there's any stigma to that. Piggybacking off Stockpickr for my ideas for Mad Money. But I realized that I'm really piggybacking off a pioneering strategy that you developed. So I am curious how you got the idea of even setting up a site that would be a social networking site to talk about really good managers and what they do.
Well, you know, it's an interesting question because the first thing you said was piggybacking has no stigma, but actually there is sort of a stigma to it. In fact, when I first started doing the strategy, this was a couple of years ago, Bob Chapman, who's an activist hedge fund manager, he actually called me up and essentially said the whole notion of piggybacking these activists is remora. And I had to look at what remora was, but it's some kind of parasitic fish. So he was very upset about all the investors piggybacking his approaches, although I don't know why, because it usually drives the stock up. But we were doing this strategy a couple years ago for a fairly big firm. It was very successful, and then we were approached by another hedge fund to manage up to $200 million just in this strategy. And the strategy would basically be and we were modeling this all out. We took the top, let's say, 80 hedge funds, many of them activists, and we would take all of their top positions, and we would simply diversify across all of them. We would always try to get into positions lower than the activist price. We'd be diversified by sector, by activist, by industry, and it was very successful. So we really considered, should we take this 150 to 200 million, trade it, obviously, you know, hopefully do well and make some money. There were two conditions which made me unhappy. One was I had to stop all writing. So I had to stop writing for TheStreet.com, Financial Times.
Is that because of regulatory reasons, or they just didn't feel it was appropriate?
Both. This one particular hedge fund just completely wanted to stay below the radar.
Some firms just hate the media. We have to respect that.
And so they were just very nervous about it. The second thing actually was even more of a concern, which is I didn't believe in, there's a saying, when you hedge, it's like taking twice the risk for half the return. Right. So if I had to, even if with 200 million, if you have to short the spiders or the Qs for every position you own, I still didn't really even see how, you could end up having a very good year for your strategy, but still have a minimal return and make minimal money.
Right.
And I was having such a great kind of ongoing conversation with all my readers about the articles I was writing about these activists, and we had everything modeled out anyway. So we just simply turned our spreadsheets into Stockpickr, and then from there just started adding more and more features, based on your feedback and other feedback.
Well, let me point out, to go back to the Chapman issue on stigma. I never let funds of funds into my hedge fund because I thought they were piggybacking. What they would do is look at my record, they'd shift money back and forth. I didn't like that. But no one ever criticized that industry, and yet that industry is much more parasitic because they do very little and they take a big percent.
I agree. Let me just say, I run a fund of funds, so we invest in about 15 other hedge funds, and I am a parasite.
But you see, I don't think, I would point out that maybe the issue is that the Chapmans don't get anything back from it, whereas that you do get something back when it comes to fund of funds. You get the assets. So maybe the issue is the profit from it is nil. Now, I regarded the fund of fund people as being the reason why I didn't want them, frankly, is because my predecessor the antecedent took the money was because I didn't want hot money.
Yes, and the problem with funds of funds is that just like hedge funds depend on monthly results, fund of funds oddly even depend more on monthly results because funds of funds are not supposed to be down ever.
Right, they're also like checking accounts,
Right, well, some hedge funds stayed up front. We're going to be volatile. We'll have down months, we'll have up months. But funds of funds, if you're even down like 0.5% in a month, all your investors are saying, "Oh, I thought this is an absolute return strategy."
Right.
And to be honest, right now you can get more from good CDs out there than many funds of funds are returning. The average fund of funds is returning much lower than the hedge fund index, which is also returning much lower than the S&P 500 right now. So it's a horrible industry.
Well, but
that's why we're here.
Okay, but what I like about Stockpickr is that you don't you get the benefit without having to give them the assets. and you also have the benefit of the community. Like when I go into answers, I was very prickly today because one of the things that someone asked me was, does the Goldman Halliburton downgrade make you less like Halliburton less? And then underneath it, someone wrote,
I saw your answer to
people
that.
don't downgrade for no reason. And what I said, no, people downgrade for wrong reasons. So it's not no reason. They have reasons they're wrong. I mean, why is Halliburton well behind the group? Well, because of this pressure pumping business. It's very, I know we're switching back and forth here, but the pressure pumping business, 60% of their contracts are already locked in. So they're not going to miss the quarter. Secondly, pessimism creates a price on its own. The guy who downgrades Halliburton is looking at the situation as if the stock's at 30 to me. Because at 30 is where the pressure pumping business was bad. Now, Schlumberger gave a talk 3 weeks ago where they said the pressure pumping business is bad. Had you listened when that guy said it, you would have sold Halliburton at 33. So Halliburton then goes to 36 and change. I like to make that gain. I think what you have to recognize is companies themselves are not static. They see what can be done. Stocks themselves are not static. They discount negatives. So, I mean, when I was reading that, I again, what I'm trying to do, apropos of the discussion we had a couple weeks ago, or maybe last week, in the answers column, is to enlighten what I would do. I am not saying you go do it, but I want to enlighten people about the way I look at the world. And one of the things that I do that I think is confuses people is that I approach it as if you're my colleague. And I think people aren't used to a colleague who is a hedge fund manager, and they almost want to treat the colleague as if he or she doesn't have any insight or track record. And it's one of the reasons why I think there's a very great reluctance for hedge fund managers to share, because it's not psychically that positive a thing to do.
Well, I think that's right. I think that's why, Chapman was saying there's this remora effect. But I totally agree with your comments, by the way, on funds of funds, which is, again, with Stockpickr, it's almost like you could be the fund of funds without
that's what I like
with the extra
about it.
liquidity, without paying any fees.
Right.
You get to pick the best positions. You get to move in and out of all these positions whenever you want, instead of being obligated to hold 5% positions. So anyway, thanks for the question.
Thank you. Way to turn the table.
So this is James Altucher at TheStreet.com TV.